The Debt Management Office is set to conduct a 215 billion naira Treasury bills auction today. Traders at Access Bank say they expect rates to increase marginally today. I have Ladi Belo, a fixed income dealer at Access Bank, and he joins me for a midweek update on activities on the fixed income market. Thank you so much for joining us on the show today, Ladi. Let's now start off with the auction we're expecting today. The volume, 215 billion naira. Cautious optimism is the element playing out here. But let's talk through the rates, the anticipated rates that we're having.
Right. Hello, David. Thank you for having me. So like you rightfully mentioned, we have about 215 billion that the DMO intends to roll over today. We saw the last stop rates at the auction close around 4, 5, and 8.5% respectively on the 91, 182 and 364-day maturities. We don't expect that much of a change in the 91 and 182-day stop rates, but we expect a slight change in the 1-year maturity in terms of the stop rates, which could hover around the 8.5% mark where it closed previously. We also expect to see quite a bit of subscription given the elevated market liquidity levels that we've seen in recent times. We opened the day with about 65 billion positive, so we expect the auction to be relatively strong despite the mixed sentiments that we've experienced in the past couple of trading sessions. Nevertheless, the previous auctions have seen steady hikes in the 1-year rate, but we don't expect the same trajectory at this particular auction, given the need for some of the local banks to deploy their idle funds ahead of the discretionary CRR debit that's passed by the CBN at the end of the week.
Okay, Ladi, and talking about what we should also expect come next week, this is already midweek, and after this bond bill auction, we have another one coming next week for bonds.
That's correct. So the DMO intends to offer between 70 to 80 billion across the standard buckets. Usually it's the short, medium and long tenured instruments. To open the week, we saw the DMO decide to take out the 20-year reopening, which is the 2042 maturity, which had in excess of 1 trillion naira outstanding. They did this in a bid to raise some more funds on other instruments that have a relatively low outstanding, and it was switched with the 2037 instrument, which currently has slightly under 600 billion outstanding. Nevertheless, we expect the auction to remain fairly weak across the 25s and the 32s, that's the short and medium tenured maturities, where we expect a bit of an increment in rates on the longer tenured maturity. It's been a while since they've offered the 2037 in the market, so we expect some healthy demand on that front, given the high coupon on this instrument as well.
Okay, now, Ladi, let's also shift our conversation now a little bit to the money market, where we're also seeing the currency trading pattern here. Tell us updates, what's playing out there?
Not much, is business as usual there. We saw the money market rates open at about 65 billion positive, like I mentioned earlier. We've seen the OBB, OPR and overnight rates hover around the 12.3 and 12.83% mark respectively. This represents a 34 basis points drop in terms of yield movement day on day, but by and large it's business as usual. The rates fluctuates depending on the liquidity in the system, which has generally been tight, but over the last week, like I said earlier as well, we've experienced some healthy flows stemming from the FAC disbursement by the federal government.
And in the short term, what's the picture you think will be painted here?
I think that the liquidity in the system will thin out very soon, although we have a few coupons in terms of some of the bonds coming in the course of September. So we expect to see a bit of mixed sentiments. At this point in time, the bond players are demanding for slightly higher rates in the market. So at the auction, stemming from the 14% levels that we've seen at the previous auction, despite the fact that we've switched from the 2042 to the 2037 maturity, we still expect rates to inch up on the 25s and the 32s as well, and strong demand on the 37s, as this is where markets will be able to take advantage of the fairly elevated yields in the market. This bond is currently at around 13.7% in the secondary market, and we expect an increment in rates in the primary markets to mirror the market realities.
And talking about mirroring the market realities, there are no surprises here from these elements that you're saying. Is that what investors should go buy?
Yes, I think so as well. I believe that whilst looking at the inflation report, which has steady risen, Currently, we're around 9.64%, which represents about 104 basis points from the preceding auction. MPR is being maintained currently at about 14%. So generally speaking, we expect to see a bit more increment in rates to mirror the spread we're seeing in terms of the negative returns or negative real returns from the inflation when compared to the interest rate environment. So we expect to see an increment in rates to match the current interest rate reality, although we've seen a bit of demand on some of the shorter tenured instruments, which we haven't seen in previous times, especially on the Treasury bills space.
Inflation definitely remains one of the buzzwords for the season, and we also have in the Monetary Policy Committee meeting for the month of September coming very soon as well. In terms of your anticipation as well, what do you think might be some of the curveballs that would also have to deal with from that meeting?
Well, for the first time in a long time, we've seen a general consensus where a lot of the members of the committee have voted for an increment in monetary policy rates. That has happened at the last two MPCs. This time around, we expect that rates would stabilize around these levels until market sort of finds its level in terms of where the reference rate should be, as well as in terms of where the interest rate should be in the secondary debt markets in the country.